The market is currently closed for the weekend, so let us look directly at the definitive closing figures for Datavault AI Inc., trading under the ticker symbol DVLT on the NASDAQ. As of the final closing bell on Friday, June 5, 2026 at 4 p.m. Eastern Time, Datavault AI stock settled at exactly 0.4294 per share. This represents a downswing from its intraday opening price of 0.4573, reflecting a volatile session where the stock encountered immediate selling pressure despite a flood of massive headlines hitting the wires. If you look at the raw trading volume, over 46 million shares changed hands in that single session, a massive surge compared to normal historical baselines, showing intense retail and institutional tug-of-war. While the headline numbers might look like a typical microcap sell-off, the real structural narrative unfolding beneath this 0.43 price point is something most retail traders are completely misinterpreting right now. Just hours ago, management dropped a bombshell regulatory filing revealing a non-binding term sheet for a staggering $2 billion structured financing transaction with a major institutional counterparty, Helmex. The headline numbers suggest a massive capital injection that dwarfs the company's current market capitalization of roughly $367 million. However, the hidden reality that is causing the smart capital to hesitate involves a binding obligation to pay a non-refundable $25 million upfront fee by June 4, funded through direct Bitcoin liquidations and immediate receivables, alongside a clause that could give this institutional entity majority voting control and board domination rights. This is a classic example where the public narrative screams massive institutional backing, while the actual mechanics of the deal point to extreme structural dilution and a total shift in corporate governance. The general consensus among market participants utilizing popular investing sites or individual brokerage choices is that Datavault AI stock is an affordable, explosive bet on artificial intelligence data monetization. Retail investors scanning through the Robinhood app or configuring their SoFi Invest active accounts see a sub-$1 stock that recently underwent a major corporate rebrand from Weiser Technologies, thinking they are catching a hidden software player at the ground floor. The prevailing expectation is that its partnerships, including integrations with major enterprise platforms, will automatically scale into high-margin recurring software revenues. However, the reality of the balance sheet challenges this simplistic thesis. The corporate entity is currently unprofitable and faces significant cash burn pressures, which is exactly why they are pursuing such aggressive, complex, and potentially dilutive structured financing deals. When you check individual user portfolios across platforms like Robinhood or Interactive Brokers, the excitement around the name often masks the immediate operational friction the company faces in transitioning from its legacy wireless audio roots into a pure-play enterprise data powerhouse. To truly understand why the stock is behaving this way, we have to look closely at the mechanics of recent trading sessions and institutional patterns. The equity has exhibited massive daily swings, with the 52-week trading range spanning from a rock-bottom 0.25 to a brief high of 4.10. This extreme beta means that any piece of data can send the stock into a tailspin or a massive rally. In May, the company executed a registered direct offering of over 109 million shares at 0.55 per share, which immediately put a structural ceiling on the equity price and dilution pressure on existing stakeholders. Institutional activity tracked via large-scale clearing firms reveals that while some speculative funds are building positions, insiders have been net sellers over the past quarter. This creates a fascinating divergence. Retail traders executing orders via Robinhood stock trading platforms or using self-investing tools are buying into the momentum of the $2 billion financing news, while institutional desks utilizing advanced Interactive Brokers trading platforms are actively hedging against the corporate governance risks outlined in the fine print of the 8K filings. Let us pivot slightly to establish exactly what this business model looks like under the hood, stripping away the market noise. Datavault AI Inc. was originally incorporated back in 2010 as Summit Semiconductor, eventually becoming Weiser Technologies before completing an asset purchase from privately held Datavault Holdings at the end of 2024 and adopting its current name in early 2025. Historically, the company specialized in wireless audio standards and data over sound technologies, which explain its legacy product lines like Weiser E and its ADIO platform. Today, the restructured enterprise operates data management platforms with high computing capabilities across North America, Europe, and the Asia-Pacific region. Its primary business strategy focuses on delivering secure data management systems where enterprise assets are evaluated and monetized through specialized digital agents, alongside projects focused on the tokenization of real-world assets on blockchain infrastructure. This legacy mix of audio hardware patterns and cutting-edge data valuation software creates a unique corporate structure that requires intensive research to evaluate properly, whether you are using basic Robinhood investment trackers or performing deep fundamental screens through a sophisticated interactive brokers platform. Financially, management has set an incredibly ambitious bar for the near future, recently reiterating its full-year revenue target of at least $200 million. This target represents a projected 400% increase year-over-year, a growth trajectory that would turn heads on any trading desk from retail chat rooms to high-end wealth management offices. Yet, according to historical data compiled by major analytics providers, the trailing 12-month figures show a deep net loss of over $122 million against a traditional gross profit baseline. This massive gap between current operational losses and future triple-digit revenue projections is the exact source of the tension dictating the daily stock swings. For an investor utilizing an individual brokerage account or looking for investment help through automated options like Schwab Intelligent Portfolios, this stock represents a high-stakes crossroads. If the company hits that $200 million revenue target, the current 0.43 share price will look like an absurd mispricing. If the cash burn forces more dilutive registered direct offerings before that revenue materializes, the equity faces a tough road ahead. Comment below how many shares of Datavault AI Inc. you currently hold in your portfolio and whether you are buying this recent dip. Looking out into the coming months, the future outlook for the equity hinges entirely on how these specific catalysts play out against operational realities. There are two distinct paths ahead. In the bullish scenario, the non-binding structured financing agreement with Helmex progresses into a definitive, legally binding contract. The initial $500 million tranche would instantly de-risk the balance sheet, providing the necessary runway to scale its enterprise software products and execute its exclusive global tokenization mandates, such as its recent agreement to bring commodity-backed assets to 24/7 trading platforms. This outcome would rapidly shift the market perception, causing analysts to re-evaluate the stock against its $3 consensus price targets. Conversely, the bearish scenario cannot be ignored. The requirement to deploy millions in capital upfront for a non-binding agreement carries structural risk. If the deal falls through, or if the resulting share issuance dilutes current equity holders by more than 50% while handing over control of the board of directors, the structural upside for retail investors could be significantly capped, regardless of overall revenue growth. When evaluating an asset with this level of volatility, the choice of your trading tools and investment strategy becomes just as vital as the stock analysis itself. Investors approach these microcap tech plays through vastly different avenues. Some choose the hands-off path, utilizing automated wealth solutions like an intelligent portfolio or a robo-advisor to keep their main capital insulated while using a separate individual brokerage account for speculative trades. Others lean heavily on comprehensive ecosystems, turning to established platforms like Fidelity for a mix of core stability through diversified index funds while maintaining a distinct allocation for active stock trading. The tools you use to track these fast-moving metrics matter immensely. For instance, monitoring institutional block orders, short interest metrics, and filing updates requires a robust interface, whether that is the Fidelity mobile app, a specialized active trading environment, or the low-fee direct access routing found on an interactive broker's account. Having real-time clarity on order execution and volume spikes can be the difference between getting caught in a retail bull trap or executing a disciplined entry. Ultimately, the central insight regarding Datavault AI Inc. rests on the sharp contrast between the narrative expectation of a massive $2 billion capital injection and the structural reality of aggressive corporate restructuring and dilution. The market has priced this equity at 0.43 because it is demanding proof that the legacy transformation can deliver the promised $200 million in recurring revenue without entirely wiping out early shareholders through equity expansion. It is a classic textbook example of an asymmetric microcap setup where the technology and partnerships are expanding rapidly, but the balance sheet architecture requires careful handling. Navigating an investment of this profile requires moving past superficial headlines and tracking the hard operational milestones, regulatory filings, and capital tranches as they land. By analyzing the structural mechanics instead of chasing short-term price momentum, investors can position themselves rationally, ensuring their expectations are firmly anchored in economic reality rather than speculative hype.